Off today with Alcoa reporting its first quarter earnings, but stock markets are nervous. The latest round of nerves started on Friday when two giants of the internet world, Google and Netflix, whose share prices have surged over the past year, were hammered as investors had a change of heart and decided prices were too high. Well, yesterday the sell-off continued with the Dow, the S&P and the Nasdaq all closing down heavily. So what is going on? Well, let's talk now to James Shugg. He's Senior Economist at Westpac Institutional Bank and he joins us now. James, always good to talk to you.
Great to be here.
What is going on?
Well, I think there's a realisation, or a sense at least, that valuations in the tech sector were getting too extended. And there may be also some caution about the US economy in particular starting to come through. I know, there is a consensus view that the US economy is actually in pretty good shape, the recovery is continuing, but the data hasn't been that supportive of late, and our sense is that there's going to be some disappointment on the US economy. You factor that in along with the valuations that are extended, and it created a sell sort of sense for the tech stocks.
So is that what it is? It's the fact that tech stocks, do you think, or some investors are thinking they've been overvalued and that's going to be an issue?
Yeah, and on the traditional measures, price to earnings ratios and so on, they are well extended, or have been well extended, not just in the US either, but in other markets too.
I mean, some would argue that firms in the US are possibly, although they are focusing on results and earnings, are not investing as much as they were.
I think that's absolutely the case, and we're going to probably see continued good results on the whole. But it's all about the focus on the bottom line. It's about cost cutting. It's about financial reorganisation. There hasn't been the investment that we'd like to see that would ensure that the economy remains productive going forward. You can't just keep cutting costs forever. And that suggests that we're going to see some disappointing results, perhaps in 2 or 3 quarters' time, and particularly with the Federal Reserve unwinding its stimulus. That's been a big support for the market as well. There may not be much to support stocks in the US after the second half of this year.
Almost seems like a perfect storm of different events that are happening now. What are we expecting from this earnings season, though? Because I know the markets look pretty sensitive right now to anything that might be a little bit off.
I reckon that we'll probably be surprised to the upside again, but it'll be more on the basis of the bottom line results rather than the revenue numbers and the sales numbers. They may tend to disappoint, but the bottom line results, I think, will look pretty good. And that's consistent with what I'm saying. It's all about reorganisation, cost cutting, to get the bottom line number to satisfy the markets, but they're not doing anything in terms of sales and investment, which is really necessary for the longer term.
And what about what the impact of all this is having on European indices and Asian markets?
Well, it's always the case that the flavour of the US trading day transmits through Asia, via Asia into Europe, and I suspect we'll have a weaker opening. And there are issues peculiar to Europe, of course, as well.
Such as?
Well, the ECB, is it going to stimulus? Is it going to put in place quantitative easing? They're kind of waiting for the next inflation numbers to see if they pick up. If they don't, I think quantitative easing is actually a real prospect for Europe. And if it gets confirmed, that'll be a big positive. If markets are kept hanging and waiting, like they have been over the last few months by Draghi, I think that'll be a big source of disappointment.
And of course, in emerging markets, very much in focus still right now as
That's
well.
right, and they've been suffering because the Fed's been unwinding its stimulus, and a lot of that extra cash was leaking into those markets, and so those countries that have current account deficits in particular are really suffering. Our view is that the US won't be lifting interest rates anytime soon, and that will be perhaps provide some support at least for emerging markets going forward.
Okay, James Shugg, good to talk to you. Thank you very much for that insight. Right, time for a look at some of the day's other business news making the headlines, and support for the Windows